What if I tell you there is a simple, repeatable shorting strategy in the financial markets that almost every time gives you 5% to 10% of the return on the risk taken? If you don't know that already, then I'm going to show you in this video, so watch till the end. What I'm going to show you guys right now is how the pattern looks like in drawing, so it's easier for you to spot it on the charts, and it could be true for any market. A market initially has a tight range. It's a consolidation. The formation of this particular setup takes some time. The market will come out of that consolidation and move towards the upper side in 3 pushes. That's push 1, that's push 2, and that's push 3. Because markets move in 3 pushes, if you know, you know. Once these pushes are complete, the market goes sideways into a tight range. That is where the dealers kind of start to trap traders in both directions. So these are inducements and then the trap. As you can see, the peak is formed. The market kind of makes this box in a tight range. It's called consolidation. For this particular trade setup, they are highly visible on a daily, 4-hour and a 1-hour time frame, and the entries would be on a 15-minute time frame chart. So the formation of this trade setup is that on the front side there was a tight consolidation. The market completes 3 pushes up here on the left, and then it runs into a tight consolidation. This consolidation could be 2 days or it could be 3 days, given each day has 3 sessions. So at minimum, I personally look for 6 trading sessions, 2 from Asia, 2 London, 2 New York sessions, where the market goes sideways. And even if it breaks, it's fine. But after it breaks a lower structure, the market goes back at least the half or the 50% of the initial price in the box, and then it starts its intended move after trapping those people. As you can see, push 1, push 2, and push 3, and these are the key levels that you see up here. The formation takes place on the front side, looking the left part of the chart, 3 pushes, and the box that you see up here, it has to be a key level. If you look at the chart from a higher time frame, maybe an area where the market flipped the zone previously. It's a 1,000 round figure price point or double zero figures, but your goal is to enter in this market right around here. So your goal should be to enter right around here, right where the box is, because what happens is the initial structure gets broken, and then this area during a specific time within the New York session or the trading session, you can target these areas and then wait for the move to continue. Your stop obviously goes above this peak. There are times when the market makers or the dealers could hold a market's price, or they could go back towards the peak again. However, the probabilities of this particular trade setup are almost 90% based on my observations and what I have seen. So talking about the time frame, we start from a daily time frame. The key levels marked on my chart are coming from the daily time frames. 4-hour time frame, if you get to see this, it takes multiple days to build this up, but it's very powerful. You can drop it down further to 1-hour time frame, which kind of gives you very clear picture of how these get formed up. Once you have 6 sessions, or in some cases 9 sessions passed by, the traders are caught on the wrong side, and then the market's price goes back to grab the liquidity where the pump started. I personally like to short markets because it takes way less time to destroy something than to build it up. So this is my favorite trade setup, and hopefully it will help you guys. Let me show you a few chart examples how this gets formed. All right, this is Gold's daily chart, high candle, and as you can see, we had a big drop after the huge pump in the month of January, and then the market dropped for 2 days, almost coming back to 4,400, coming from the 5,600. So this was a big drop, and then the market went back and made some changes. This is 20 period exponential moving average. It works like a magnet, if you already know, but let's do some marking of the candles. The reason we do this, these are the zone flip areas on the higher time frame nodes. If you don't know what those are already, then probably you need to learn, but this is where the markets are, you know, highly liquid areas where the markets push back. This also happens to be the low of the day from this particular candle, where the market reversed and then followed by a big 2 days continuous dump. So when the market comes back down here, the dealers kind of switch the price back up. It's a creeping up trend, but the goal is to take the market back into those areas where they flip the zone and square the books in terms of accounting, and then switch it back on a daily time frame. So once you draw this particular line, that's where you have the potential reversal areas where you can target from this low to this high and the 50% of that range. It is great. I mean, you're talking about 1,500 to 2,000 pips already, which is a fantastic trade, and that can significantly grow your trading accounts. These are the high zones on this one. Another thing you want to do is if you understand the concept of initial balance, because new month, new timing cycle. So you mark the high of the first trading day of the calendar month and then the lower price point of first trading day of the month. This is where the market set up the initial balance, and if the range expands and then goes back in, then you can at least keep them as your relevant target for taking profits or making entries into the market. But these are your areas, because when you know, if we use the classical chart patterns, Richard Schaubacher, then if we look at this initial move, the 50% of this will come around here, and if you have a line right here, which is like a high volume node, price got rejected here, and then once it broke above, it came back and reset. So these are called the zone flip areas, and this is where the dealers square the books, and once it hits on those areas, you can set alerts and then you look for the opportunities. Now let's look at the 4-hour time frame. As you can see how the market and these period separators are the week beginning. So the previous week market at the beginning of February pumps back up, dumps again, and then they start pumping the price up back to this 5100 level. And once it gets rejected over there, as you can see, it literally, this candle, the bear candle, was from yesterday, the Thursday, and then the first 3 days were just creeping trend. It's like climbing stairs, and then on the back side of the pattern or the trade setup is just an elevator down or the lift down. So that's how these become very highly visible. So this type of trade, if you just take one trade a week, it's a great risk to reward. Let's look at it on a 1-hour time frame. If you remember, we talked about new week, new timing cycle. If you don't understand what this means, that means you have been fed a lot of retail garbage. But opening range of the week, new timing cycle, Tuesday was an inside day. That means the trading was in a tight range. And then on Wednesday, the day 3 of the week, market climbs back up to that. This is the blue line that I was showing you earlier. That is a zone flip area. Once the price touches on that, it gets immediately rejected. So Asia, London sideways conversation. Every time you see a market in a tight consolidation between Asia, London, but at least for these ones, I would give minimum 6 sessions for this to form up. And I'll show you different examples. But as you can see, this was push 1. You see push 2, and then it just goes in, forms this low, and then you put this up on the top, and then you put this on the top. Do expect the markets to go back up there and test these areas that you mark on your charts from the zone flip areas or book squaring areas. And these are very sensitive. The market makers or the dealer really respect those. Once it gets rejected, if you were doing session trade, these were good opportunities. But again, like I said, my goal is, does this picture look like I look like the one that I showed you in the beginning? This is very good trade in terms of risk to reward. And then as you can see on a 1-hour time frame, how it's really respecting the highest price of the first trading day in the calendar month. In this case, it's February. And I can tell you, these you could find in currency pairs, commodities, indices, any other markets. Crypto, 1, 2, 3. And sideways consolidation, and bam. So when the entire market structure is formed on a 1-hour time frame, as you can see, so Monday, Tuesday, Wednesday, if you are a type of guy who wants to get in early, then maybe you could put limit orders right there and manage your risk. But always trade with confirmations. At minimum, you should let the market set up for 6 sessions in the sideways consolidation. And when you see this tight consolidation for 2 sessions, especially on a gold or any market, you know it's coming. If we talk about entries and how do I enter, I would drop it down onto 15 minutes chart. And as you can see, this one was this candle was like 10 o'clock New York time, right here, the one I'm showing it on my crosshairs. And 4-hour time rotations are key. If you don't know about them, then you need to learn about the time rotations. But once the market traces back, as you can see, this was primarily 8 o'clock in the morning. This is like a pin hammer, inverted pin hammer. Market drops at 10 a.m. Market retraces back up, and you could literally enter anywhere around here. Your stop could go here or your stop could go above here. Really depends how much risk you have. But again, these are highly profitable trade. Once you drop them, they are over in an hour or two. And as you can see, from 50-60 over to 4900, that's like 1500 to 2000 pips right there. Now let's look at the Japanese yen US dollar market. As you can see, we had a big sell-off after the Bank of Japan changed their interest rates and policy. The market just dumped big time. This was high of the year in November. December was inside November, so it was an inside month. The market breaks out on a daily time frame for 3 days. They break out, the market pulls back into the range, goes back up, creates this double top trap and a shift pattern, and bam, they just move the market right away. And as you can see, if on a higher time frame, if you see, you could literally see how it's from here, the whole thing forms 1, 2, 3, and then induce in a trap, and then pattern within a pattern. On a daily time frame, you see double top here, and then the market breaks it down right here. So if we look at the classical chart patterns, as you could see right there, once market breaks this particular structure, the middle part or the lower part of that, it retraces back on a daily time frame. So these are the areas where the previous year high, this was a kill zone, and then This is a zone flip. This is like the middle part of the M structure, and then market comes back in. On Monday, it just drops right away. This is a daily time frame, and you can see how market just dumps it hard. If we look at it on a 4-hour time frame, and if you have marked this, as you could see, this was the previous week, entire week. Monday goes back up, and again, if I talk about classical chart patterns, you could see how markets expand at least 100% of the initial box. Anyway, so this was the good trade in Asia session. On Sunday, Bank of Japan announced some monetary policy. The market drops, bam, and then in 3 days, the market comes back into this. So if we drop it to 1-hour time frame, this becomes highly visible, and this is exactly what I was talking about. So if you take on this particular, so if you look at this particular box, this could be your tight consolidation. You could see how market price goes up. It shows a pin hammer on a 1-hour time frame. That means that price got rejected. Once it closes below the 20 exponential period moving average, then you could make an entry here with a retracement and then put your stop right above, or you could put 1-bar stop right here depending on your risk. And these are your areas where you could expect the market. One of this zone right there, Monday, Tuesday, Wednesday, that's a low of the week. Thursday is a low of the week, and then the market is expecting to rebound back. So you could see this high area. This is 2 or 3 days of hold, and then you could mark these areas because this is where the pump started. So as you could see, the price comes back into this area. Remember, patience is the key in trading. Accurate thesis on a wrong timing is just as bad as a failure. So focus on your discipline, build your muscle memory, learn these trade setups, print out these charts, and understand the price behavior. If you find this strategy simple and repeatable, and this has added some value, just like the video, subscribe to the channel. If you have any question, post them in the comment section. Until next time, stay green, guys.